At 9 in the morning, everything looks normal. Glass towers, marble floors, security at the doors. But walk inside, and something feels off. Entire floors are silent, no keyboards clicking, no meetings starting late, no voices arguing over coffee. Lights are on, but nobody is home. Now imagine that silence spreading, from one floor to one building to an entire downtown. Because the real danger isn't a crash you watch on TV, it's not red charts, not breaking news. It's a slow bank run you don't see until one morning the doors don't open. Right now, commercial real estate is sitting on $1 trillion fuse, and it's already burning. For decades, the deal was simple. Offices stay full, rents stay high, loans get paid. Banks treated office towers like solid, untouchable collateral. Investors treated them like machines that never sleep. Debt was packaged, rated, and sold as safe income. Pensions bought it, funds bought it, cities depended on it. The entire system ran on one assumption: companies would always need desks in the sky. That assumption just broke. Remote work didn't fade, it hardened into a permanent habit. Companies cut space, teams went hybrid. Some tenants didn't renegotiate, they disappeared. In major US cities, vacancy didn't creep up, it jumped into double digits and kept climbing. And when rent drops, a building doesn't just earn less, it breaks the math. Cash flow collapses, loan coverage fails, valuations fall off a cliff. The tower still stands, but financially, it's already empty. Here's where the trap closes. Most office loans are short-term, 5 years, 7, 10 if you were lucky. When they mature, owners must refinance, but rates jumped, lenders tightened, and property values crashed. So a building that once supported a massive loan suddenly can't support even half of it. That's when owners stop fighting. They hand back the keys, write off the loss, and walk away. This is why the danger isn't real estate itself. It's who's holding the paper. Regional banks hold a huge share of these office loans. Not Wall Street giants, local banks, quiet banks, trusted banks. When payments stop, balance sheets don't explode. They bleed, loss after loss, quarter after quarter. Then one headline hits, one rumor spreads, one nervous morning, and deposits move. A modern bank run doesn't need lines outside a branch. It needs a phone and fear. In 2008, the trigger was housing. This time, it's empty towers in the center of American cities. Different asset, same chain reaction. Falling values, bad loans, shaken banks, fleeing deposits. But there's a twist. Office buildings don't snap back. You can't force companies into leases if the world changed and the desks stayed empty. Timing is everything, and the most dangerous moment is when loans reset. A massive wave of office debt matures in 2024 and 2025. Refinancing hits at the worst possible time. Losses that were hidden suddenly become real, and once banks start marking assets down, confidence goes next. Fast, contagious, irreversible. This isn't about panic, it's about math catching up. So here's the real question. If this fuse reaches the banks, who's standing closest to the blast? Because financial collapses don't announce themselves. They move quietly, then all at once. By the time everyone notices, the damage is already done. If you want sharp, no-nonsense investigations into the next financial breaks before they hit the headlines, subscribe. Next, which banks are most exposed, and the warning signs to watch before the silence spreads.